Welcome to Consumer Lending Perspectives, a podcast where we talk to financial industry leaders about trends in consumer assets, underwriting, performance, customer acquisition, fraud prevention, liquidity, and more. Hosted by Jeff Bogan, CFO at Upgrade and Fintech veteran. This show delivers key insights on the topics that matter most to financial executives.
Welcome back. I'm your host, Jeff Bogan. Today's guest is John Toohig, a managing director at Raymond James and head of Whole Loan Trading Group. John is responsible for day-to-day trading of loans, portfolio analysis, structuring of whole loan sales, participations, and various structured products. He's sort of known in the industry as the go-to source for banks and credit unions who want to buy and sell consumer loans. At Upgrade, we've had the opportunity to work with John for the last 4 years, and we're honored to have you here to share some of your wisdom. Welcome to the podcast, John.
No, Jeff, thank you. It's been a wonderful relationship with Upgrade over the years. We've been real fortunate to be able to work with you and looking forward to speaking today as well.
Agree. And we're hoping to get some of your insights that you've basically given us over the last 4 years, particularly around the consumer loan space. Maybe to start, given basically what's happened over the last couple of years, can you summarize what you've seen happen to banks and credit unions in 22 and 23 as we all faced pretty significant rate increases? And then related to that, like, what have you seen happen within the last 12 months?
So if we can even take it 1 year forward, 2021 was just an incredible year for these depositories. We're still, if we can all remember COVID, and we can even remember kind of deeply working from home and branches were still shut down and restaurants were still weird and the world was kind of on its head, right? Depositories had a lot of cash coming in the door. We had a ton of stimulus coming out of the government. Deposits skyrocketed, but loan demand didn't quite turn on. Everybody was still a little deer in the headlights. We were trying to make loans, but the branch wasn't really working for traditional banks and credit unions out there. And that was really where we saw a number of fintechs kind of step in and offer that more digital model to lending, which was interesting to watch how that kind of came together. And they were so flush with cash and they needed earning assets. And it wasn't just fintech loans. It was auto loans, it was marine loans, it was RV loans, mortgages. We had this massive refi wave going through in resi land. Commercial was a bit weird, right? But the consumer side of the bank and the credit union balance sheet just kind of really started to explode. March, April, May of 22 is when we started to feel those rate hikes. And from a capital market standpoint, from a loan trading standpoint, we felt it probably June. And it was really a tale of two halves. The first 3 months of the year were nuts. January, February, March, just still a lot of people putting money to work, a lot of transactions going forward. Banks, credit unions, making and buying a lot of loans, trying to make earning assets, trying to improve margins, trying to get that money out and into the system. But they were a little slow. And there was the lag between finance and treasury and loan operations and loan originations. And usually loan originations wins, right? They're the ones driving that interest margin earning assets inside the institution. And so as rates were rising and liquidity was starting to kind of get sucked out of the system, there was a gap there. There's a gap there we saw in autos where, there were times when they were making auto loans below even the 2-year treasury. I'm just speaking specifically to prime autos. And fintech loans, which had tremendous pricing pressures on them in the first quarter of the year, where if you changed your rates by just a handful of basis points, money would move somewhere else. They were slow to raise rates. So by the end of the year, they started to figure that out, but that was too late. They'd made a lot of loans that were underwater, and we saw kind of a pricing situation where pricing started to go upside down. You saw it acutely in mortgages. A 3% mortgage versus a 7% mortgage is a massive price differential. Same thing for auto loans. A 5% auto loan versus a 10% auto loan, massive price differential. So 22 was not a fun year. 22 was a very difficult year for institutions, but they didn't learn that until 23. And now obviously they're fighting the deposit and the net interest margin pressures that they have today.
Knowing that, Would you have advised banks and credit unions and even fintechs for that matter to have done something faster in 22 in light of that, knowing what we know now?
I mean, of course, hindsight's 2020. I'd love to say we all had that crystal ball. We were saying at the time, raise your rates, raise your rates, raise your rates. But again, there's this very interesting war between Treasury, people holding the purse strings, and they had not yet felt the deposit outflows, and then loan originations. Loan originations was happy, right? They
Yep.
were putting money to work, and they were putting money to work fast. That's what they're paid to do.
Yep.
The CFO and the treasurers out there were starting to see deposit costs go up and cost of funds go up. They're starting to say, hang on, hang on, hang on, hang on. It was easier to see in 23 when everything kind of started to slow down a little bit. But when you start talking 75 basis point rate hikes, it's tough for institutions in that fog of war to
Yep.
really kind of have their arms around it.
So then what happened in 23, kind of once
Well,
everyone was aligned that there was a new rate environment and the world
right,
had changed?
right. So frozen is a lot of the word. We saw trading volumes plummet. I've told this joke a couple of times on the mortgage side of the ledger. We traded about $8.5 billion in mortgages in 22. In 23, we traded 400 million,
Oh, wow.
8.5 billion to 400 million in a calendar year. I
Yeah.
mean, that's a move, right? And that's all those 3% 30-year fixed rate mortgages that are worth 85 cents on the dollar today. You couldn't get enough of them
Yep.
back in 21 and 22. Now you look at somebody and say, hey, I'll say a 7% mortgage, and they'll look at you kind of funny because they have enough cash to fund it. And not maybe as exemplified on longer duration assets in fintech and consumer and auto and RV and HELOC, because it's a shorter duration asset, so you don't see the price move nearly as much. But it's just as acute, right?
Yep.
Whether it be a 5% auto loan for a 10% auto loan today, or an 8% fintech loan that's a 16% fintech loan today. I mean, those are moves, but it took a while for that to kind of sink in.
Yep. Yep. So then sort of market's frozen.
Mm.
What happens next?
Frozen's not quite the right word. There was a lag. We
A
needed
lag.
current
Got it.
coupons to catch up.
Yep.
We needed kind of a level set as to what their deposit costs were. It wasn't free money anymore.
Yep.
CDs, brokered CDs, wholesale funds were 5.5%.
Yep.
So now when we're talking about net interest margin, I mean, there were still a lot of folks out there making loans at 5 and 5.5%, right? So negative margin loans. I mean, there's a minute there where, hey guys, when we were doing asset liability work for a lot of these institutions and we just had to walk them through the math, I know it's banking 101, but if you have a 5% cost of funds, you have to have an earning asset above 5%. And
Yeah.
don't forget to factor in CECL and cost to originate and all of the things that go along with it. But that took a minute to work through the system.
Yeah. And we were spoiled by the whole
Lord,
environment
were
over
we?
the last 10
Yeah.
years. So it's not shocking that happened.
Right. And then, add in that little mini banking crisis with SVB
Yes.
and Signature, and that kind of tossed things around for a little while also. So there was a little bit of fear in the
Yep.
market.
Yep.
And that's largely behind us now. And we're feeling of late a much more healthy market. Trading volumes are up. The second half of the year has been much, much stronger than the first half of the year. We're getting further and further away from the bank crisis. We're getting rate cuts now. We're
Yep.
starting to see liquidity come back in to the system. It feels much, much more stable.
Yeah. And I think the expectations around a potential consumer recession and was it going to be a hard landing versus soft landing? We've seen that in our conversations with clients that I think everyone is now sort of in the camp of it's likely to be a soft landing,
Right.
which we think is going to be further help the market.
Yeah, no, I agree. We're not through it yet, so I want to be careful of
Yep.
it. Where we're seeing some distress, and to be clear, it's in different pockets for different products, but that 22 vintage of loan doesn't seem to be performing as well. That's when that economic morphine and stimulus kind of started to fade,
Yep.
and lending standards hadn't quite tightened yet.
Yep.
Two, delinquencies, particularly on the lower end of credit and the younger end of borrowers, seem to be performing worse than the higher end of credit and with borrowers that have had lifelong savings.
Yeah.
So there is a little bit of a have and have not happening, but
Right.
it's not catastrophic. It's not cataclysmic. It's what a lot of the analysts, the credit analysts, call normalization. That's just kind of code for we're back to kind of a 2018, 2019 kind of vintage.
Yeah.
We're not talking about 2008.
Yeah.
We're not talking about that kind of a crash.
Which is probably healthy for the market long term, right? To
I
be
think
in a more
so.
normalized market
Yeah.
environment.
Higher for longer, even though we are in a falling rate. I mean, these kind of coupons are healthy, are more normal, or more historically normal. Now, back to your opening comment, we've been a bit
Yep.
spoiled on it, right? I mean, a 3% mortgage has really allowed the American economy to thrive because of a very low debt service coverage for that particular consumer.
Yep.
Those 24 originations that are higher coupons, are showing a little bit of distress again on those lower credits and younger borrowers. But that's all kind of part of that credit stack as you look at it.
Yeah. So what has happened? Obviously, we had the 50 bip rate cut. Any major strategies that you're seeing from your clients in terms of either the secondary market, what asset classes are more in favor now versus out of favor? Has there been any dramatic shifts in the last month?
Well, I have to ask you, were you expecting 50 or were you expecting a
I
quarter?
personally was expecting 25.
I was and we just hosted our second annual loan conference in Nashville 2 weeks ago, and we did kind of an unofficial poll. Raise your hand. What do you think? And which the room said. I mean, the vast majority of the room said 25 basis points. So I'm
Right.
in color me in the camp. I wasn't
Yeah.
ready for 50. Right.
Yep.
So there's that. I'm still curious if we see another cut, like what 2-3 days after the election. I
Yeah.
think is when that meeting is. So I'm curious, was he front loading the cuts to accommodate maybe not doing something
Right.
in November? But the markets seem to think we're going to get 100 basis points and next year another 100 basis points. So
Yep.
I start to worry that if we get 200 basis points of cuts, are we talking about a recessionary? Are we
Right.
talking about more of a hard landing than a soft landing? And then my answer changes pretty significantly to you if that's the tone of things, if we see a weakening job market. But to answer your question, a lot of folks are trying to lock in yield, trying to lock in duration. For instance, 30-year fixed rate residential mortgage ARMs. We've really seen kind of mortgage volumes come back to my 2023 was just a terrible year for mortgage trading. We've already tripled that volume for the first half of the year. So mortgages still not maybe as back as 21, but certainly much more healthy. HELOCs have been phenomenal.
Yep.
All of the refi business that's vanished in Resi land has come back into HELOCs. Consumer and auto have done well, up in credit, consumer and up in credit in auto, marine, RV, a little bit longer duration. Folks have liked that. As we've kind of looked across the board, that 3 to 4 year part of the curve, folks have been quite attracted to. And if they can get a little bit extra yield, particularly on stronger credit, they seem to be hunting for it.
And so do you think that,
Oddly,
yeah,
sorry, Jeff.
I would say that duration story, do you think that's really going to continue to play out the first half of next year?
Well, I mean, if you remember December of last year, we were going to get 6 rate cuts,
Yep.
right? So not a lot of people were signing up for high coupon paper if they thought it was going to refi, immediately.
Yep.
Now it feels as if people are kind of, let's say a mortgage rate today is 6.25. And let's say an auto yield is somewhere around 6.5. If we can lock some of that in, but we do need to be a little mindful of what prepayments might do to those yields if we get back to that world.
Right.
That's a bit of the trade right now is, are we really going to see an uptick in prepayment speeds?
Yeah. Yeah. Let's shift to credit a little bit. We've talked about kind of rates and so forth. There's obviously credit underperformance pretty much across all consumer assets. 22 vintage, you've already pointed out, was one of the weaker ones. What have you seen in terms of credit tightening or credit loosening from your clients? Really, let's just focus on 24. Like, how has that changed from January to today? Or is everyone still tight? What are you seeing?
Well, so though, if we can take and put the fourth quarter of last year into the conversation, that's
Yep.
really when we saw the world pucker. Because again, if
Yep.
you remember then October, November, we were really talking recession, right?
Right.
And it was imminent and it was right around the corner. And
Right.
every economist was promising that it was here and it didn't come, right? So
Yeah.
if again, you think of the loan engine The loan engine doesn't trade like bonds, right? Where you're just looking at treasuries. They've got to set their rate sheet and they got to get their loan officers out there pounding the street. And there's a lag there. So things that you feel that were done in the fourth quarter of last year went into the first quarter of this year.
Right.
And we found that there was really a lack of originations. Loan volumes had slowed, and that was largely across the board for consumer. And some of that was rate induced, some of that was credit induced. Um, that shifted
Yeah.
towards the end of the quarter, March, April, May of 24. We started to really feel the energy come back. We started to see the engine start to produce the loans again. We started to have sellers come back into the market. Buyers were starting to get some deposits. They're starting to get some cash flow back. Payoffs are starting to happen, and they were ready to put money back to work. They had gone relatively short over the last couple of years because they weren't really sure where rates were going to go, getting some money back from the bond portfolio, loan demand starting to come back. So first quarter, not so great. Second quarter, quite good. And third quarter is shaping up to be very attractive as well, going into, I think, to the fourth quarter, which will be even better. So I can definitely feel a kind of a first half, second half story
Mm-hmm.
24, where the early part of the first half was fairly tepid. The back half seems to be quite good from a
Yeah, what
trading
about
volume standpoint.
liquidity? Yeah, what about
Yep.
liquidity? After SVB, it felt like
Yep.
every bank and credit union in the system was trying to
Yep.
create more liquidity within their balance sheet. Where are we in that cycle today?
Well, I mean, let's talk about liquidity. I mean, you can be lazy today and you can go out and offer a 5.5% 12-month CD and you can generate liquidity, but it's expensive.
Right.
So the message that I've been giving to a lot of our clients is let's create smart liquidity. You have to have a deposit program driven around a loan effort. So if you're making a mortgage, maybe you give them a quarter point discount to have $20,000 of deposits
Right.
with you. Make an auto loan. Maybe you give them a quarter point rate cut for, $2,000 of deposit. You make a commercial real estate loan, tie it to deposits at a
Right.
lower cost of funds. If you're going out just lazily looking for wholesale funding or, just competing on rate with deposits, you're going to see that cost of funds slowly bump up. So, but it has felt even just organically though,
Mm-hmm.
absent the tying it to lending or tying it to relationship, that liquidity is back and deposits are back. It's not 2020 and 2021, but if you look at the call report information, it's up 1-2%. And it's a modest increase, but it's moving in the right direction.
And then how did liquidity impact organic loan growth from their own originations versus sort of buying bulk pools of loans?
Yeah,
And
that
because
was
that's one thing that we saw was,
yeah.
people really went inward, focused on organic opportunities, were less likely to buy loan
Yep.
portfolios. We're seeing that start to kind of that trend to reverse now.
Yep.
What have you seen in
Yeah,
that
no,
regard?
that was real, and still, even to a degree, is today. So, I mean, let's just use auto lending. The idea of a direct auto loan is a borrower or a member comes into a branch and makes the loan. They go back to the dealership and they take it. An indirect auto loan is just coming through Route One or Dealer Track, and is there really a banking or lending relationship with the counterparty? No, probably not. We saw a very deliberate approach by a lot of institutions to turn indirect lending off, not just
Mm-hmm.
in mortgage or not just in auto, but in anything, correspondent lending as opposed to their own organic retail originations, indirect autos versus direct autos. Some of the fintech lending we saw get pulled back.
Yep.
And that's, if there wasn't a deposit relationship associated with that and they were having to choose that next dollar of funding and that next dollar of equity that they were spending towards a loan, they would rather make it towards a core borrower, a core member of the institution,
Yeah, of
as
course.
opposed to just hand it to, Joe Smith walking in off the street. That's starting to unwind a bit as liquidity is coming back and the loan engine isn't quite keeping pace with that, right? So as we're starting to see loan to deposit and loan to share ratios kind of come back down a smidge, you're starting to feel that bulk purchase story kind of come back into the market.
And is that a trend that you anticipate to
I
play out?
do. Yeah, I
Yeah.
think that's going to persist. And that's some of the optimism I have. Falling rates make things a lot easier too, right?
Yeah.
Sellers like to sell loans at gains. So the
Right.
problem that we've experienced in a rising rate environment was you'd make a loan 2 months ago and immediately have to sell it at 90 cents on the dollar because the Fed raised rates 75 bips.
Right.
The opposite is now true. I made a loan
Right.
yesterday at a higher rate and rates are down. I can now sell a loan at a gain. That's better for the seller, right? They can get into
Yep.
some fee income, they can
Right.
generate some gain on sale. And now you just start trying to find the haves and the have-nots. Who has liquidity? Who has the loan engine? How do we marry those two together and move forward?
Right. And typically the longer duration assets are the ones that you think are probably going to obviously the biggest beneficiary of this, but also the ones where there might be the most interest in selling and trading.
I think the problem depositories are going to have, and this hasn't played out yet, but I do think margins are going to narrow. And there's going to be an uncomfortable point here soon because I do think deposit costs are going to be sticky this time
Hmm.
down. And loan yields are going to fall faster, I think, than deposit uh,
Yep.
pricing is.
Yep.
It will catch up, but just like there's a lending lag on 3 months to kind of turn the engine on, so too there will be a funding lag on the way
Right.
down. Those folks that locked in 18-month CDs at 5.5%, 6%, that's going to sting a
Yep.
little bit, right?
Yep.
Those that were a little bit more disciplined and stayed more in the 7 to 12 month range and admittedly may have paid up, but get the chance to reset it on the way down maybe a little sooner.
Yep.
I think from a liability standpoint, we'll be in maybe a better situation than maybe what they're feeling on the asset side. So I do expect to see margins narrow in the near term, but I don't think that's a problem unless credit breaks.
Right.
And then you'll start to see margins widen back
Right.
out.
So those with the 18-month 5.5% CDs, um, that's just going to hit margin, but you don't see it driving any
No.
asset sales, asset purchases.
Well, I mean, what I think you're going to feel here in the very near future is a wave of M&A. And we've even seen a bit of that of late in the depository space. And if there's any indication from the investment bankers that we work with here at Raymond James, because they've been on a bit of a heater right now. They're on the top of the league table. And just in having some conversations, there's plenty more M&A kind of coming behind that. And so as you find those institutions that do have strong engines and you find those more community maybe institutions that are flush with cash but just don't have money to put to work, there's going to be a very natural fit there. And I think you'll see a flurry of that that kind of will spark some origination as well.
That's interesting. Yeah, I could definitely see that playing out. There's a lot of
Yeah.
industrial logic to that.
Yep.
What about non-deposit funding? So we have seen some credit unions start to do securitizations.
Yep.
That's not something that I think they've done at scale
Yep.
in prior years. Is that just a one time it's part of the cycle thing, or is this a new normal?
No, securitization is, yeah, it's definitely going to be something that persists. No question about it. It's a huge focus for us here at Ray J as well, as we kind of try to find where those, assets are. A lot of the challenge is finding is the counterparty ready for it, right? Do they have all of the policies and procedures? Do they have the servicing mechanisms in place? Do they have the collections? Do they have the engine? I mean, part of the problem with securitization, you need to do a 200 to $300 million deal. You're only making $20 million in loans a month, and all of a sudden I hand you $200 million in loans. How long does it take to put that cash back into the system and redeploy it as a true funding mechanism, right? So there's no question there will be more of it. Both banks and credit unions at more the community depository scale are going to look at it, particularly as the capital markets get more receptive to it. I mean, truth be told, the performance of those loans from smaller institutions is often better because there actually is a real lending and borrowing relationship with the counterparty. So that long term, the performance of the bonds turns out to be a net positive too for the bondholders. But we're just going to have to see more of that kind of work its way through, really from a sophistication and a coaching standpoint. That hey, community depositories, both banks and credit unions that are sub 10 billion in assets, this is a possibility for you. You can do this. It is something that the capital markets are receptive to.
And how investors in these securitizations, how are they thinking about this? Are they raising larger pools of capital to invest in these securitizations? I mean, if it's a trend that's going to happen and it's potentially better asset performance, it seems like it's something that the securitization bond buyers would definitely be interested in.
With each new trade and being able to follow it on Bloomberg and being able to watch and track that credit performance, that prepayment performance, that story that is that institution, as you see the pre-sale reports and you track the trades over life, that just adds, one more believer to the mix,
Right.
right? As they start to get confident that This isn't some bucket shop that, doesn't have its head screwed on straight and can't ultimately perform from a counterparty standpoint. And then they see it 12 months later, they see it 18 months later. Proof's in the pudding, right? And you get to
Right.
watch that track out with math.
Right.
That's where I think you just see more and more investors kind of come into it, particularly as these institutions shine with the relationships that they have with
Yep.
their borrowers and their members.
Yeah, it's gonna be interesting to look at that market. I mean, Raymond James clearly is a leader in it, and so I could see how it's attractive for a lot of these banks and credit unions to tap into that source of funding. And you
Well,
guys will probably be doing a lot of business in the future with that.
yeah, we love it both ways. We listen, if you're only wanting to do a smaller whole loan trade and it's, 10, 20, $50 million and the economics don't make sense to put that into a CUSIP, no
Yep.
problem. If you want
Yep.
to take a look on the other hand on something maybe a bit more sophisticated and you're looking for a higher par balance of 20 and or 200 and $300 million in the secondary market and reach that next tier of investor,
Yep.
great. Our job is to
Yep.
present that idea to you side by side, and you, the client, make a choice. I want to put my big boy pants on and go and hit that tier one shop, or
Right.
what, I just need 20 million today just to take a little bit of gain and take a little heat off the stove.
Yep.
The option is yours, whichever
Yep.
direction you want to go.
One-stop shop. I like
That's
it.
it. That's the goal. Yep.
What about fintechs? Like, what are you saying? How are
Yep.
banks and credit unions? It's I think when fintechs first started in 08, 9, 10, 11, 12, banks and credit unions didn't really understand how to work with fintechs. That certainly changed
Sure.
starting about 6, 7 years ago. Banks and credit unions focus more inwardly the last couple of years, as we've talked about. What do you see for the future with fintech partnerships and the value that each partner can bring to each other?
I- I'm a I remain a big believer in the fintech story, and we invested in it even before kind of what happened with COVID and all of the influx of dollars. But I live this every day. Our customers have not and cannot really spend the dollars to compete with some of their larger tier one kind of brethren, right? I mean, in mortgage land, it's probably never been more articulated than what Rocket Mortgage did and kind of revolutionized
Right.
that particular market. And so, in my mind, fintech is a partnership, and it is meant to be collaborative to the depository. It is not meant to wreck or destroy or
Hmm.
replace the depository. And I think 10 years ago, Jeff, to your point, there was a little bit of looking at each other like, are we competitors or are we complementers of one another? And we both had our guns kind of pointed at each other, and we didn't know kind of where the lines of the battle were drawn. I think what we learned and have seen with some successful conversions and some fintechs that have even taken on bank charters or just chose more of a depository partnership kind of model, as we're kind of watching that synergy between the two institutions form. Depositories have cheap cost of capital, low cost of funds. Fintechs have a better tech mechanism to generate loan growth, and I'm lumping fintech only into loan growth. I'm not even looking to what it's doing with systems and all the other kind
Right.
of fintechs that are out there,
Right.
but the specific loan originating fintechs that are in existence today. I think that natural evolution will continue, and those institutions that are ignoring it are doing so at their detriment. And those
Hmm.
institutions that have embraced it have found a great partner and a maybe adding expertise that they didn't have in house, and distribution and client gathering and a touch that they may not have been able to organically generate through their retail branch model. And that fin and tech marriage is going to continue to evolve, I think, in a complementary standpoint going forward. It won't be perfect. It won't be without a few bumps in the road, but I think it's healthy, and I think community depositories need a little shot in the arm of
Right.
some tech infusion.
And so, what advice for depositories that haven't done one of these partnerships as a way to kind of deploy liquidity, buy assets, et cetera? What advice would you give them to make sure that it's successful?
Yep. I mean, choose your partners wisely. It's one of the reasons we liked Upgrade when we first kind of started the partnership with them. That you were an up in credit shop, where we're not a fan of going way, way down in credit for depositories. That's more of the hedge fund world, right? And debt managers and the what like. We've encouraged up in credit. We've encouraged flexibility. Those institutions that don't say, "Hey, one size fits all." Those institutions that kind of offer the ability to customize the relationship. Getting into products that you know and understand. Don't just go jump into the deep end of the pond and start doing something enormously erotic or different. So it's important that they understand kind of how the loan is being made, and regulatory wise we're starting to feel that a little bit also. As you are the lender at the end of the day. The fintech may have been the funnel to bring you the loan, but you are ultimately responsible for that loan too. So those
Right.
are, I think, all important. It's just do your homework.
Hmm.
There are some really good pieces out there by the regulators that give you how to do your due diligence. What
Hmm.
questions to ask. How do you integrate with the institution? How are they collecting on the loan? Go into it really with an eyes wide open kind of approach, which I
Yeah.
think is important. And there was a minute there where it felt like a bit like an arms race, just because they had a lot of cash and they needed to put money to work really, really quick. And oh my God, I got to get set up. I got to set up. Slow down. Do your homework.
Right.
Become comfortable. Form good, deep partnerships with good, strong, reputable companies. That's
Right.
really kind of what I would suggest.
Yeah, and I think it's great that the regulators are giving guidance, telling banks and credit unions what expectations they have for the partnerships and so
Mm,
forth, because it's going to frankly protect everyone at the end of the
that's right.
day. So I think it's great that that's a new development that's obviously occurred in the last, you know, 24, 36 months
Yep.
that I think was badly needed. I think it's great. Um, let's get to predictions. So
Uh,
what are the top 3 to 5 predictions or themes that you think are going to dominate the depository space in 25?
well, I think 25 is going to be better than 24. I don't think that's too big of a stretch. I think origination volumes are going to be up. I think we're going to get further and further away from the last quarter of 23, which I think was the bottom and probably where we saw peak rates. So falling rates are going to help, and they're also going to further assist with these deeply underwater assets, both in the bond and
Right.
the loan portfolio, which is going to take a little bit of the pressure off a lot of these institutions. Where they're fighting those thinner margins, and they can either use some loan sales to fix things, or can take a little bit of the pain points off. I'd already alluded to, I do expect there to be tightening margins,
Right.
but I think that ultimately cures itself throughout 2025 on maybe the back end. But I still think we're going to have a Fed that's a little slower than we want it to be. I think the market has already priced in too many cuts. I think Powell has been, again, I was caught off guard on the 50 versus
Right. I was just say you
25,
and I were both
right?
wrong,
So
but
color me
we might
wrong
be right.
but he has been quite transparent along the way of a slower pace. And so the market has had a tendency to get ahead of itself on how quick he'll respond. But I hope that a gradually falling market ensures a soft landing. If we start to see a really falling rate interest rate market, it means we're more induced for a hard landing.
Right.
I'm curious what student loan debt does
Hmm.
now that it's kind of hitting the credit wall, and we're starting to see payments or credit payments hit the FICO scores. So that's, I think, a wild card for us. Recent political moves, the things in the
Right.
Middle East could be a shaker for us. Wars
Right.
obviously change a lot of things, but I think my quick answer is 25 should be better than 24.
Yeah. Let's hope for a normalized rate environment,
Yep,
soft landing,
yep,
no material degradation in credit, and
yep,
we can kind of all get back to growth. And
yep.
that's certainly
And an
what we're
uptick in
counting on.
M&A would be my other one, though. I think we'll see
Right.
a
Right.
very robust 2025 for mergers.
Right. Right. Yeah. If you're a depository and you're interested in M&A, reach out to John or someone else from Raymond James to talk about it, because I'm sure you're having a lot of
A lot of
conversations about that.
conversations in the boardroom right now. A lot of
Okay.
conversations. Yep.
Well, thank you for your time. Any other words of wisdom for the community out there?
No, this has been Jeff. I really appreciate you asking me to join, and excited and just appreciative of the partnership, certainly with Upgrade, and all that we've been able to accomplish together. But just delighted to be able to come in and chat to the listeners.
Thank you, John. Truly enjoyable. Thank you for being a guest on the Consumer Lending Perspectives podcast brought to you by Upgrade. You can find out more insights from John on his ultra-popular LinkedIn weekly newsletter, Let's Talk Loans. I read it every week. Highly recommend you go on LinkedIn and subscribe to that. A lot of really good market intel and advice. And then we also welcome you to submit ideas for future guests and topics to investor@upgrade.com. Until next time, I'm your host, Jeff Bogan. Thank you.
Thanks for listening to Consumer Lending Perspectives. Subscribe for more expert insights and strategies from finance leaders. And share the show with your network. Until next time, stay ahead in the ever-evolving world of consumer finance.